In today's episode, I sit down with Kirstin Hunter, CEO of Birchal, the equity crowdfunding platform that for 8 years since equity crowdfunding first became legal in Australia, has facilitated more than $241 million of investment across 338 successful crowdsourced funding offers from over 140,000 individual investments. We're also joined by Dom Pym, a significant shareholder in Birchal, who also co-founded Up, Australia's highest rated bank, and Dom invests through his family office Euphemia, plus he's just launched Triple Bubble, Australia's first dedicated fintech fund. Now, I recently became a Birchal shareholder myself, which came out of a bus ride with Dom where he laid out why he keeps investing, the changes he's pushing for, and what the future looks like that resolves the issues investors in crowdfunding campaigns have experienced to date. Regular listeners will know that we've talked about equity crowdfunding on Transparent VC a number of times, and it's an industry still maturing that needs to solve a number of issues so it can better serve the founders and investors it's trying to connect. We think it has a great role to play in the ecosystem and keen to help get it right. The conversation on the bus with Dom led to a discussion with Kirstin, who'd not long taken over as CEO, and I felt there was good alignment on the issues that needed to be resolved, so I wrote a check and here we are. We get into crowdsourced funding and who it actually suits, who it doesn't, areas that need to be improved, and how angel, VC and crowdfunding can work together in this ecosystem. Okay, let's get into it. Kirstin and Dom, it is really great to have you on Transparent VC. Thanks for joining us. I wanted to kick off just quickly on the podcast. We've spoken about crowdfunding from time to time in various connotations, and then I'd not met you before, Dom, and we're on a bus traveling from Perth to Margaret River for 3 hours, and over the course of 3 hours I went from maybe raising more issues than good to the next minute going, how do I write a check? How do I get involved in this vision that you've sold me? So it's probably one of the most expensive bus rides I've had in a little while.
That's fair call. Yeah. I remember that bus ride fondly because, there's a bunch of venture capitalists together who have reasonably strong views. And, the regulatory environment in Australia has not really been set up for, friendly play between the different parts of the industry. What we would love is for the whole industry to work together, and all the way from private equity and venture capital at one end down to, syndicates and angel investors and crowdfunding at the other end, and sort of everything in between. There's lots of different sources of capital in Australia, and what we want is for the startups to have open slather and be able to get capital from wherever is the best place for them, and not necessarily for those channels to be competing. What we see in the UK and the US, for example, is crowdfunding and syndicates and angel investors all complementing debt funding as well as venture funding and private equity. They all work together, to the point where the government even chips in. If you're investing on crowdfunding in the UK, the government will match dollar for dollar for qualifying investments. And so as a startup, you either have to raise half as much money and know that the rest is coming in from the government, or as an investor, you only have to put in half as much money and you still get the benefit. So I think there's, some things we could learn from our overseas compatriots. But one of the ones I love is that the venture capitalists not only co-invest with the crowdfunders overseas, but they also raise money on the crowdfunding platform. So like, let's say Airtree, Square Peg, Blackbird are going out to raise $1 billion fund or Tribe or Triple Bubble, or, we might be raising 50 or 100 million or whatever. But when you go out to do that, you could actually put half or a tenth or whatever of your raise onto a crowdfunding platform, and then regular Aussies could participate as LPs. I think that's totally awesome. In Australia, that's illegal or breach of the regulations. So that's not something that we can do in Australia right now. But I think that's where the future lies, and we'll be working hard with government to hopefully make some changes so that the venture capitalists and the crowdfunders and the angel investors and the syndicates, can all work together more cohesively, to what I say, elevate the ecosystem. So maybe some of that I said to you on the bus, I'm not sure.
No, it was all that and a lot more. And so, Kirstin, you joined last year.
Yeah.
What led you to joining Birchal?
Yeah, so I have been in the startup ecosystem for about 10 years. I have a sort of fairly active profile within the community. I was one of the co-founders of Future Super, which is ethical and fossil fuel-free superannuation, kind of the sole survivor of the generation of startup super funds, the only one that's really sort of made it through to scale. I've done a couple of other different roles in the ecosystem. I've run the Techstars Accelerator here in Sydney, And so for a lot of people, when I came across to Birchal and took the job as CEO after co-founder Matt Vitale stepped down, it felt like a bit of a strange move. But to me, it made perfect sense in terms of kind of the direction that I was going in my career. And what I mean by that is I've been in financial services for 20 years. Before I even came across the startups, I was a financial services consultant. And I love the fact that financial services is the great unlock in people's lives. You know, it's the banking that allows us to transact our day-to-day, the superannuation that gives us dignity in retirement, the insurance that provides a safety net. And so I knew I wanted to stay within the financial services space, and Birchal just is such a perfect mix of the things that I've been working for over the last 10 years. So on the retail investor side, a lot of the work that we did at Future Super was giving ordinary Australians the opportunity to invest in the renewable energy boom through their superannuation. And so making something that otherwise was only accessible to large cheque investors available to anybody by pooling their money together and investing through their super. And then on the founder side, through my work at Techstars, I've been doing a lot of work with founders who, you know, don't match the typical archetype of VC investable founders. So consumer-facing businesses, hard tech, founders of different sort of gender backgrounds, different ability requirements, neurodiverse founders. Like I built a very diverse cohort of founders and then helped them connect with capital both through the accelerator and afterwards. And so Birchal to me was bringing both those worlds together. I get to play a role in democratizing access to investments for ordinary people to back the next generation of Australian innovators. And I get to work with founders to connect them with sources of capital that otherwise they might not be able to access. And I think that side of things, the founder access to capital, has only become more defined in the last 18 months as AI has become such a big driver of investment at the VC end of town, that any business that doesn't kind of have a punny integration of AI in its title really struggles to get access to capital. It doesn't mean they're a bad business. It just means that they don't meet the venture capital investment profile right now. And so it actually, as venture has skewed more towards AI, it's opened up this massive opportunity for crowdsourced funding to connect really, really great businesses that have really, really strong returns potential with capital through the community rather than through single decision makers.
I think it was 8 years ago in Australia, they introduced regulation that made it possible to do equity crowdfunding. A lot of us would have known crowdfunding as something where you invest in a company and then you get a free t-shirt or something, you know, like this sort of thing. And you're not really investing in the company, you're just giving them money up front. Well, that was pretty wild and it went crazy for, you know, a decade or so. And then equity crowdfunding came along where as a regular person, you can put in a small check, $50, $20, $100, $1,000, whatever you have. You can put that in and actually get equity, get shares in the company. And so equity crowdfunding is really nascent in Australia. It's quite new. But overseas, say, for example, the UK has the two biggest crowdfunders in the world, and then the US has a dominant market as well. And what you see is that those markets are 10 times, 20 times the size of our market on a per capita basis. So it gives us an indication that if the regular folks are able to get shares in a company on the stock exchange, now regular people can get shares in private companies as well that aren't yet on the stock exchange. So those startups, every single startup, you know, starts as a private company. So I think equity crowdfunding fills a gap in the market where it enables wholesale investors, sophisticated investors, and regular retail investors access to startups that they would otherwise not have had. I mean, where do you get your deal flow from? You know, at the pub or, you know, on the squash court or something like that? You know, most people don't have that opportunity to get that sort of deal flow, and equity crowdfunding gives them that opportunity.
Yeah. So coming into this role, Kirstin, what are some of the things that you've seen and that you're now looking to, and what are some of the lessons that were learned from the nascent technology and nascent industry that has to go through its own life cycle of developing and becoming a little more mature?
Yeah. And so when the tech boom of 2020, 2021, 2022 hit, crowdsourced funding as an industry was 2 to 3 years old in Australia. So as you say, super early days, low kind of volumes coming through, still quite experimental in how we were thinking about how to build product for investors as well as for founders. And I think as well, it's probably worth, I think one of the big lessons I think that we've had to learn is how to find the balance between the two customers who we serve, being the founders and the investors. And the sticking point around that is around valuations. So, I mean, one of the common things that I've heard from people who have had concerns or criticisms about the way crowdsourced funding has been running is the valuations are crazy. Founders come in, they set their valuations sky high, retail investors don't know any better, so there's no one there to sort of push back on the founders and to reset their valuations at a reasonable level. In the defense of crowdsourced funding, in that same period, valuations are pretty crazy in venture capital as well. They just were behind the scenes a little bit more, whereas in crowdsourced funding, everything is fully disclosed, it's public, it's listed on the website what the valuation is. And so you're able to have an opinion on the valuation that founders have struck and that investors are choosing to back them at. One of the big lessons that I've had to spend a lot of time helping founders understand is valuation. I think you often think as a founder, when you're setting the valuation as your business, I should put my valuation as high as possible. That's going to feel really great to me if I've built a company that on paper looks like it's worth millions and millions of dollars. It's going to mean that as I'm raising capital, I'm bringing money into the business, I'm losing less of the ownership of the company, I'm diluting myself less, I'm giving away less ownership to other people, so I'm keeping more of the ownership for myself. And so those kind of factors, I think, can push founders towards setting a high valuation. Whereas the reset is that wherever you set your valuation now, that's the hurdle you've got to cross in future. So setting a super high valuation now means that unless you shoot the lights out and smash that valuation for your next round, you're either having a conversation with investors around why you didn't hit their expectations, or you're having a conversation about why you've lowered your valuation compared to your previous round. So that's one thing. And then the second thing is, in a crowdsourced funding campaign, a successful campaign relies on getting a small number of large checks and then a large number of small checks. So the minimum investment amount for most crowdsourced funding campaigns is $250. So really, really small. So your typical profile is you might have a few, $50,000, $100,000 checks, maybe one that's kind of a few $100,000, and then you'd have a couple of hundred or a couple of thousand small checks. The issue with setting your valuation too high as a founder coming through crowdsourced funding is that you risk that small number of large checks, because those are the investors who are going to be a lot more sensitive to where the valuation's sitting. If they're going to be thinking about putting in a $500,000 personal check into a business, they want to feel that $500,000 has a prospect to turn into more money. And for them, having a valuation that's reasonable means that they can see a time in the future, 3 years, 5 years, 10 years, whatever that might be, where the company valuation increases and then the value of their investment increases as well. So those larger check investors in a crowdsourced funding round are very sensitive to the valuation of the business, in a way that people who are putting in 200, 250 or $500 might not be so sensitive. They're there because they want to be a part of the community, and the fact that there might be a financial return for them at a point of time in the future is more of a bonus than a driver in that investment decision. But the larger check investors really are looking at the fundamentals of the business. So those couple of factors, I think, combine to help us coach founders to set their valuations at a more reasonable level. And we're seeing a big change in the way founders are approaching that on the crowd at the moment.
Yeah, I was going to say that's the role that a company like Birchal plays in market, is to understand those nuances, because you can't expect every retail investor to understand that. Don and I do it for a living, so we have to understand it. But the regular retail investor doesn't do it for a living. It's essentially for them, accepting a risk, taking a punt, investing in a friend's business, investing in something they care about. They might be passionate about a particular industry or a particular company. They might like the founders. So a lot of the time when people are making those decisions, they actually need an arbiter. They need those big investors, and they need the platform like Birchal to be able to help them understand and educate them on how this type of investment works. But look, it's going really well in terms of uptake, because in the last 8 years, I think we probably have 80,000 or more retail investors on the platform. Is that right?
Yeah, it's probably closer to 120,000. So
120.
Yeah,
so
a
like it's
a lot.
It's out of control. It's a lot, and so it actually has had good traction. And if there's 120,000 people that are invested on the platform, you can see that it's already got that early momentum. And what we want to do is get it to the millions. Really take it to the next stage and go through that growth. But I think it is exciting, and it may be nascent, but it fills a gap in the market in Australia, and so it serves a really important purpose. And probably the reason why I wanted to jump in and back it is because I've seen it work overseas, and there's absolutely no reason why it won't work in Australia other than legislation, making sure that the right regulatory environment is set in order for it to be successful.
Yeah.
So to put a little bit of colour around that, just before you jump in, Don. So we talk a lot about True North for crowdsource funding, like what are we really here for? And Revolut over in the UK is kind of my favourite example at the moment because they've just been going through a very public secondaries process. So that means shareholders have the opportunity to sell their shares to someone else, for anyone who's watching who doesn't understand the jargon. But Revolut also did their earliest raise was a crowdsource funding campaign on Crowdcube, and they had 460-ish investors come in at an average investment amount of £2,000. They are now getting a 465x return on that investment. So a £2,000 investment is worth over £1 million. And to me,
That's
like
wild.
I get goosebumps when I think about 460 new millionaires have been created because Revolut chose to take their first round through crowdsource funding. Those investors chose to jump on and back this new neobank with barely any traction, but a good idea and, you know, and something that they wanted to get behind. And then the result of that 10 years down the track is just this phenomenal outcome for everybody. So that, I think, is what we're really here for, is how can we connect great founders, great business ideas whose time has come with the community who wants what they're building, and then together create something way more awesome than the sum of those parts individually.
It's quite awesome, isn't it? I mean, those returns are extraordinary. Can I just say also
Any
that
venture
they passed,
investor would love that, right?
But they passed me. It's the one that got away because I'm on Crowdcube and at the time Cedars, which is now Republic, and I saw Monzo come along with their investment memorandum, and I saw Revolut come along, and I chose to go with Monzo, and I've had an excellent return so far. They haven't exited yet, so we're still waiting for the exit. But I passed up on Revolut. Big mistake.
Yeah,
Need to spread your bets a bit more, Dom.
Yeah,
we've all got our anti-portfolio. But I think on that point, why I, after that bus ride, then caught up with you, Kirstin, is that it was more for me an understanding of some of the challenges and concerns that had been raised and you guys then wanting to do something about it. And so with Birchal now wanting to take more of a front foot on things like Val, whereas part of the problems prior is that it wasn't. And then other things we've discussed on like mechanisms to keep shareholders up to date so they don't learn about things in the media, things to at least have some kind of process to keep in touch with the company around execution. And the more that we could, I think, as a little ecosystem on our side, work in there, then the outcomes are more likely to be better. And that's why I'm keen to try and facilitate. And one of my one of the great relationships I've made in this industry is with Chris Gillings. I didn't know Chris, and it was on this podcast, like one of the early podcasts, where he didn't want the stats for crowdfunding in cut-through venture. And when I saw that, I got a little bit lippy on the podcast and said some things that he actually sent me the episode not so long ago, and I listened to it and I was like, fuck, if I was me, I would not have even reached out to me. I was a bit of a dick. But Chris, in his dry sense of humor style, and reached out and then we had a chat and we unpacked a few things. It's about trying to say, okay, there's some issues here to resolve, and why I really want to see you guys flourish is that in the conversations we've had and the actions that you've taken, you've seen them, and I think it would be best, if we work together on it. And so in that context, who is the ideal client profile of someone doing a crowdfunding raise? So a lot of listeners here are founders and investors, both angel and VC LP, who should use crowdsource funding, and then maybe as well, who shouldn't, because sometimes, something that is a solution for everyone is a solution for no one. So who isn't an ideal client as well?
Yeah, it's a great point, because I think you're exactly right. Crowdsource funding is not for every founder, just like venture capital or private equity is not for every founder. And so as a founder and a business builder, you need to choose the capital stack that's going to best support your business's growth in the future. And so for crowdsource funding, we sort of talk about crowdsource funding is best suited to founders who either have a strong community around their business or have a strong community appeal. And so what do I mean by community? It might be a really strong, loyal customer base. It might be a group of people who are connected by sharing a similar problem. It might be a wait list for your product when it goes live. It might be your partners and corporate partners, and the employees who work for them. But anywhere where you've got that strong connection to a pool of people who are connected to your business. And the reason why that's important is, as I said before, crowdsource funding success relies on a large number of small checks as well as a couple of larger ones. So strong community appeal are really important. For early stage founders who haven't yet had a chance to build up a strong community, provided that you have a strong community appeal, you can still do crowdsource funding, but it's a little bit more difficult. It might require you to spend more money on digital marketing in order to reach out to the community. We might have to get a little bit more creative about how we tell the story. And so we have had a lot of success of early stage companies raising, but they have typically been where they have that community already around the product, even though the product hasn't gone to market yet. And so we are looking at the community connection. We're looking at the stage that the business is at. And so the type of questions my team and I will ask founders when we're going through our due diligence process does change depending on the stage of the business. For a later stage business that has, maybe more stable revenues, there've been a lot of breweries raise on crowdsource funding in the last couple of years. So let's take that as an example. If you're a brewery and you're doing a pretty good custom, you've got a solid clientele, you've got a strong community around you that you can draw on to invest. But what's the story that we're telling those investors about why they should back you now, why they should become a shareholder in your brewery rather than just be a customer and buy the beer? And so helping them craft that story, helping understand what they're going to use the money for is a really important part of building up for a successful crowdsource funding campaign. At the earlier stage, if we're looking at a company that might be pre-product or pre-revenue, or even at the ideation stage, it's a question of, what do we want to prove in this crowdsource funding campaign? If you're going to go through all of the effort to write your crowdsource funding offer document, prepare your pitch, engage a marketing partner to run the raise for you, it can't just be about the dollars that are getting in. What's the value that's going to come from raising capital through crowdsource funding as opposed to angel investors or, trying to pitch to a VC fund? So actually a lot of the advice that I give to super early stage founders is crowdsource funding will be a great thing for your business, but not yet. Try the friends and family pathway, try and go down an angel platform, get some money through the door, test these early validations. And once you've got something that's starting to get some traction, even if it's early stage, crowdsource funding can really pour fuel on the fire of that traction. It can be a real force multiplier for businesses that have that strong community connection to bring their community into their cap table, so that you basically have this group of customer investors who are your biggest champions out in the market. They're buying your product. They're giving it to all their friends for Christmas. They're telling their workmates that they should buy your product and tell their friends, because they know they're already a champion of the business that you're building, and now they get to share in the success when other people realize how awesome it is as well.
And from an investor's perspective, I actually started out doing a lot of investing, 15, 20 years ago in crowdfunding, and it serves lots of good purposes. So for example, you can put in a minimum investment. In the UK, it might have been £100 or £200 or whatever it was. That means that you can become a shareholder at very low risk. And what happened for me is I would invest in, say, 30 different companies, and then 3 of them would be moderately successful. So I'd invest in them again. And then 1 of them would be a breakout, and then I'd invest in them again, and maybe do that through a venture structure or through some other form of investment. But if you think about it as part of the venture life cycle, where you're raising money early stages from friends and family, you're raising money from crowdfunding, you're getting some debt or syndicate funding, you're then moving to venture, and eventually you're doing an IPO and you might do some private equity takeovers or whatever. That whole spectrum, you can invest those very, very early stages on equity crowdsource funding. The other thing is you can build a brand as an investor. So for me, most of my early investments were in fintechs, female-led companies, and environment, climate tech. And then when we formed the family office, and now we deploy 100 million in the family office, that's our thesis, is those very early stage investments, because I built a brand as someone who supports climate techs, supports fintechs, and supports female-led allocators and female-led startups. And so I think that as an investor, you can dip your toe in the water, and there's absolutely no reason why in a double-sided marketplace where you got the investors and then you got the founders, that you can, they can both, get benefits from using the equity crowdsource funding as a mechanism to raise capital or as a mechanism to invest. It's pretty good.
Yeah, it's a great point, because I think it's an easy value prop for a retail investor why they should invest through crowdsource funding. It's the only way, short of the 2012 exemption, but it's the only way that you can become a shareholder in a private company. So you could obviously invest through the ASX, you can do a bunch of other things with your money, but this is the way to invest in early stage technology companies that do tend to stay private. So whereas for people who meet the sophisticated or wholesale investor threshold, a lot of people assume that crowdsource funding is not for them, that it's for a retail only audience. But I mean, the number of people who have told me similar stories to you, Dom, about I actually cut my teeth as an investor by backing crowdsourced funding campaigns is quite staggering. I think what we offer to people who are early in their angel journey, or even people who are later in their angel investor journey, is a volume of deal flow, a variety in different investment types, and a consistent quality in disclosure that makes it really easy for you to review investments. In crowdsourced funding, the regulated disclosures is actually a real benefit for investors, because you'll open up the crowdsourced funding page, you'll pull up the offer document, it'll speak to the company strategy, it'll speak to their recent performance, it'll talk to the profiles of their directors and senior managers, you'll be able to look at the cap table, you'll be able to look at the recent financials. Everything that you would need to make an investment decision is right there in a disclosed and consistent format. So I think that's a real benefit for investors who are looking at rounding out their portfolio. You're probably not going to put a dozen large checks through crowdsourced funding in a given year. Maybe you still sort of have one or two that you might make your larger check investments, but you can spread your bets a little bit more widely by putting in smaller checks across a broader number of companies.
You can also lead. So what I've done is I've actually led rounds in equity crowdsourced funding where I put in the biggest check. And so if you've not led before, if you're running a venture fund or you're running a syndicate and you've not led, and you want to do the due diligence and you want to set the price and you want to be more influential in deals, it's actually another good way to dip your toe in the water. So I've actually done a whole bunch of them. One example would be CBN. Another example would be Birchal themselves. When Birchal ran their last, half a dozen raises, I would come in as a larger investor in order to build some momentum and help set the price and back that round as it kicks off. So there's another benefit for investors is you can build your investment muscle by using equity crowdsourced funding, because the diligence is a miles easier than it is when you're investing in early stage startups.
And so then on that theme, what do you think people are misunderstanding at the moment that around crowdsourced funding? Like, where are the areas that, if you had to dispel some myths that you commonly see, where are they?
Yeah, I mean, I think on the investor side, Chris put a really nice list of all of the kind of, myths that I have to bust as CEO of Birchal around the problems with crowdsourced funding. Just so happens I agree with them. But I think a lot of the challenges that historically have been leveled against crowdsourced funding in the past is that crowdsourced funding platforms don't do due diligence. They don't try and filter and pick the winners. They just let anyone come through and raise. That the valuations are out of step with what might be seen in the market. And that there's this sort of quality component that these are the companies that have failed to raise capital anywhere else. And so the dregs come to crowdsourced funding. None of those things, I think, have to be true. Certainly they could be true. And on a deal by deal basis, there can be those kinds of things. But I think at an industry level, there's no reason why that has to be true. So my team and I now, we are doing a lot more work in the filtering stage of the process of deciding who gets to raise. My personal screen is, I don't want anyone on the platform who I would be embarrassed if my dad invested in. He's not a professional investor. He's a swimming coach from Tweedhead. So I wouldn't want to have a company come to the platform that I wasn't confident enough that if my dad decided to invest in it, that would feel like a bad idea. We do, as I said before, we do a lot of work around the valuation with founders who are coming in to make sure that they're setting it at a level that is going to invite investors in, and that at a minimum they've had conversations with their investors around what valuation their investors think it should be. And so I think a lot of those factors we're doing a lot of work to try and dispel. The other thing as well is crowdsourced funding doesn't have to be the funding that you go to when you don't have any other options. For a lot of founders, they are choosing this source of capital because it aligns with their values. They want to serve their communities. They want to have their community on the cap table. Maybe they're an independent media organization. They don't want to risk the quality of their editorial independence by having one large check investor who could try and sway their opinions. Maybe they're, a small community group or a company that serves a really strong need in a health tech space, and they want to make sure that the people who are benefiting from the product also have a chance to share in the company's success. Revolut, again, I think is a really great example. They've done a lot of interviews over the years talking about how their crowdsourced funding investors actually propelled their company's growth. It wasn't just that they gave them capital, it's that those investors worked so hard to make sure that Revolut could, grow in the early days, get the word out, bring in new customers. And so they're a key part of that company's success story. So that's sort of, I think, what we're working on the perception side for investors looking at crowdsourced funding. On the founder side, I think, again, it's about helping them understand the real benefits that they get from raising money through crowdsourced funding, even over going through a process with venture capital. We know the stats around venture capital when it comes to funding women and mixed gender founding teams. So, all of the sort of inherent structural challenges that make accessing venture capital funding difficult for founders, I think, still exist in a crowdsourced funding environment, but on a much lower scale, because we have a diversity of investors who are making their own decisions rather than a small number of investors who, are on a spectrum of understanding their own kind of personal biases. So what we saw when we looked at the numbers last year was that women founders, men-only teams and mixed gender teams, actually mixed gender teams, the largest amount on average compared to women-only and male-only teams in the crowdsourced funding space. The average investment into each of those categories was about the same. So investors were backing founder teams with the same level of conviction, regardless of the gender composition of the teams, which I think is a super, super strong selling point for founders who might be feeling like they're shut out of the venture capital process. Oftentimes the crowd can be a way to come in and appeal to the diversity of human experience that we have. As we said before, 120,000 individual investors, and to find people who connect with you and will back you. And the large number of small checks can add up to a really great raise.
I would say the biggest myth or the biggest misunderstanding is education, like knowing about it, discovery. So there's not many people in Australia that even know it exists. And so, the opportunity to have a chat with you, Don, like this is awesome. And very grateful, because we want people to understand that it exists in the first place. And then the second is education, educating people that it's a viable source of funding, that it's a vibrant community, that it's a successful platform, that it does fit within a regulated environment. So it's very stringent in the way that it operates. It's very compliant. It's got good governance. The due diligence where, across the industry is normalized. There's a lot of education piece. So I think discovery and education, all the things Kirstin talked about, absolutely. That's the nitty gritties. But just in the first place, we want people to even know that it exists.
Yeah, and happy to play our part. And I guess once they know it exists, then being part of that deal flow, and then I'm excited to see the tools and the systems and just things that Kirstin and the team are going to be bringing out to sort of raise that ability. Because, the way I look at our little space, I don't think it's too different in that you've got to find great deals. You've then got to win great deals. You then got to support them, and then you got to get them. You got to get them exited. And I think why I really like what you guys are bringing to the table is that with the experience, Dom, of yourself, and then yourself, Kirstin, is that you're actually looking at it from a more holistic point of view. And where the early 2021, 2022, there was stuff that probably creeped in that may not have been ideal for the space. You guys have a much higher bar. But there are some regulatory challenges. And I know from one of our portcos that went through it that especially around some VAL stuff and the way things are disclosed. And I look at it and go, that's not the way I do it. I think that's not quite right, but actually it's a regulatory process. So maybe, Dom, you are often talking to people that, have some influence. Where are some of the regulations that you're trying to change? Where are you pushing to get some of those regs changed?
Yeah, the biggest ones, particularly for crowdsource funding, is the ability for venture capitalists and crowdsource funders to exist at the same time using the platform. Internationally, as I said, a venture capital firm can raise money on a platform. In Australia, you can't use crowdsource funding to raise a fund. And I think that would be a massive unlock if we were able to get that changed with regulation. So there's lots of nitty-gritties. With any regulation that comes in, and it's only 8 years old, but there's going to be unintended consequences. There's going to be some areas of overlap. There's going to be some areas of potential improvement. Oftentimes regulation gets passed and then doesn't get addressed again for a long time. What we would like is that within the first decade of crowdsource funding to be able to make appropriate tweaks. That one would be the number one that I would be lobbying for. I sit on the board of Fintech Australia, so we do a lot of lobbying of both governments, bipartisan lobbying, the government and the opposition, in order to make sure that we can represent the interests of the industry. And I think we have 480 members or something like that. So there's a lot of fintechs in Australia that are sort of caught up in the regulations, not just crowdsource funding. But specifically for crowdsource funding, that would be number one. There's probably other areas that are tricky, but they don't necessarily need to be changed. Again, it's more about education. So I'll give you an example, is that, you can only have a certain number of shareholders on a cap table. I think it's 50, isn't it? And with crowdsourced funding, you might have 2,000 or 3,000 investors or 200 or 300 investors. So there's a carve out in the regulations that allows you to have more people on your cap table if you're a equity crowdsource funded company, a startup that has that. So we don't necessarily see regulatory issues with that, but what we see is business opportunities. So if you're a company that has 1,000 or 2,000 shareholders, you're either a public company and you're listed on the stock exchange and you've got solutions to manage your back office and all that sort of stuff. And as you said, your investor communications. If you're a private company, you don't have that luxury. And none of the services that are out there are really built for those type of companies. It's different in other countries, but certainly here in Australia, one of the things that we'd like Birchal to do is horizontal commercial growth, so that we can actually build a platform that supports communicating with shareholders, supports companies that want to come back and invest again. So you've got founders who want to come and do another raise, and then you've got investors that want to build a portfolio. If you're building a portfolio, you want to understand the tax treatment. So you don't want, while it's budget time now, it just happened, over the last couple of days, you don't want new legislation that comes in to have unintended consequences. That means that when you make a portfolio of investments into equity crowdsource funding, that's going to be impacted by some adverse tax position or something like that. So I would say, they're the things that are front of mind. Kirstin, you might have some more specific crowdsource funding ones that you want to raise.
Yeah, I mean, a couple of them are sort of structural. A couple of them are kind of little niggly semantic things. So one of the big challenges is that in sort of venture and angel investing, you can use any number of different instruments, which particularly at the earlier stages give you a lot more flexibility in things like setting valuation and discounts and things like that. In crowdsource funding, we can't use safe notes, we can't use con notes, we can't do anything other than investing and becoming an ordinary shareholder. So again, particularly in the early stages, that's quite challenging. It can be challenging to work it in where a company might have raised on a safe note and then wants to do a crowdsource funding round as well. Questions around whether or not the crowdsource funding round will count as a qualified financing event. Questions around the crowdsource funding round being a price round coming after a safe note. Do you set it at a lot of founders sort of struggle with thinking about how to set the price round now versus the valuation cap in their safe note. So just a little bit of murky complexity there because we have this limitation around only being able to raise to ordinary shareholder or through the ordinary shareholder structure. At the silly end of the examples, if you're an angel investor through a syndicate, your sophisticated investor certificate lasts for 2 years. Whereas in crowdsource funding, it only lasts for 6 months. So professional investors who do this all the time, who come into crowdsource funding and make a larger check investment into a company, my team and I have to be super annoying and say, even though your sophisticated investor certificate's only 12 months old, can you please go back to your accountant and get another one because we are only allowed to accept them within the 6 months. So there's absolutely no reason why that should be the case, except that it's just a bit of a funny thing around the way it's drafted and it's never been fixed. So there's a few little things like that in the regulations. The maximum amount that a company can raise in a 12-month period is $5 million. They're not allowed to raise through crowdsource funding if they've brought in more than $25 million of revenue or have $25 million of assets. And so it limits crowdsource funding to earlier stage companies or smaller businesses. It doesn't give retail investors the opportunity to continue backing companies throughout their life cycle. So again, all of these opportunities, I think, to just make the market more inclusive, more accessible for founders and for investors, and just make the crowdsource funding component of the broader funding landscape operate with a bit more harmony.
Even just scaling with not only the businesses, but with the market itself. So when those numbers were set 8 years ago, they sort of made more sense. Whereas what we would like to do is within the first decade, we'd like to make those parameters more dynamic, so that they can potentially change with CPI, or they can change on a 5% per annum basis or something like that, so that we're not sort of locked in to those specific metrics. So I think there's a few tweaks there, but yeah, as I said, the really big one for me is making sure that venture capitalists can invest alongside crowdsource funding and can also use crowdsource funding to raise their own money. I think they'd be two big unlocks for the Australian market.
Yeah, I mean, if I disclose my full self-interest in Tribe syndicates and is got an ESVCLP, which Dom, on that same bus trip, you said that was the dumbest idea. We're completely stupid.
Yeah.
And I'm hoping we can close the loop on that. But we syndicate and have the fund. And so part of the reason why we continue to syndicate is that we have 200 LPs that are very bright. And before we actually finalize a deal, we send it out to them because someone in there knows something that we don't. And I absolutely love having that as part of our process, because not only do we find deals, the level of information is great. But on the deals that do get through in the syndicate, to be able to go to retail and actually say, hey, we've done this work. These people are in, this is what we're looking at. Here's the kind of thing. For me, that would be wonderful, because there's a lot of people in my network that don't have sophisticated investor certificates that would love to jump on the deals that I spruik at every barbecue that I possibly can, but they can't. Yeah. And so I'm hoping the government goes, all right, well, I've taken a whole lot of stuff away from you, and all of this bullshit about helping young people get into a house is actually rubbish, but I will let you get into a early stage deal because that's what you young'uns want to be in.
Yeah. Look, I think it's really important with the budget changes that we sort of see through the rhetoric. It's got nothing to do with young people and housing. It's got everything to do, from our perspective, it's, from our industry's perspective, it's got everything to do with making sure we protect the innovation and disruption of Australian startup ecosystem. The startup ecosystem, the tech sector, for example, is the second largest industry in Australia today. I don't have the numbers in front of me, but it's like hundreds of billions of dollars of contribution to the GDP. What I think we'll see is that it's also the fastest growing sector. So we want the unintended consequences to be managed. We want the carve-outs to be managed. And to your point on ESVCLP, I have a bee in my bonnet at the moment that a lot of the discussion in the last 2 days has been about making carve-outs for ESVCLPs in order for venture capitalists to be able to have appropriate tax treatment for their investments and particularly for their exits. And the same from the founder's perspective and the ESOP for the early stage employees. The employee share options program needs to not be affected unintentionally, from these changes. So if you look at the ESVCLP and you look at the ESOP, and then you look at just the capital gains proposal in its entirety, there will need to be these carve-outs. What I'm worried about is that the carve-outs will name the ESOP or will name the ESVCLP. And that means that any other structure that you have to reward your staff, or any other structure that you have like we do, we have a managed investment trust because there's unintended consequences in financial services. So Triple Bubble is investing only in fintechs, and we can't do that with an ESVCLP. You can do it, but it's difficult, and there's issues with doing it. So I want to make sure that the changes to the legislation, the carve-outs, cover off any appropriate investment structure, not just ESVCLP, including syndicates, including crowdsourced funding, including managed investment trusts, including partnerships. And then for the ESOP side of things, for the employees, we want to make sure that we can make as many millionaires as possible so that they go on to buy houses, but they also go on to make new startups and create new jobs. And in order to do that at the same scale that we see in, Tel Aviv or Berlin or San Francisco or Singapore or Hong Kong, in order to do it at that scale, we need the venture industry to grow from where it is today, say 17 billion to 170 billion to 1.7 trillion. So to do that, we need to support more than just named programs. And so the ESOP, Employee Share Options Program, is one way that employees are rewarded, but there are other ways that employees can be rewarded. I just want to make sure they don't get lost when the carve-outs are made. So there's a lot of the most vocal advocates for these changes, or these carve-outs, are the venture capital partners themselves. I haven't seen you do any LinkedIn, Don, but lots of other people you might have done, but lots of other people have been very vocal about these changes.
Yeah, well, I haven't, but Bronwyn Clune from Capital Brief put out an article that we spoke about in this morning's podcast, which I think is very good, because a lot of the stuff, though, concentrates too much on the tax position of a founder, which I don't think the majority of population give a shit about. Yeah. What we need to do a little better on is actually communicating that that's actually a secondary thing. There are potentially unintended consequences of the employment opportunities, the sovereign capabilities when you develop companies from within here, the growth opportunities. Like, that's the reason why we need to keep a healthy ecosystem, saving a founder who got a $50 million exit, $5 million in tax is not actually anything anybody's going to rally around. And what I'm trying to do is actually, we got to be more on that, because especially given Labor government, there are certain messages they're going to take. And one of them, I do not think, is the tax position of the minority. So I've got to work out how we communicate better what we're actually talking about, which is the ecosystem and what it produces.
Well, actually, the other thing that we want to think about, and most of the vocal venture capitalists are not saying this, but farmers and miners and nurses and emergency services workers, everybody is affected by the capital gains changes. So, it's great that the venture capital industry allowed and are going to get their carve-outs. And there's good reasons for that, because it's a driving force of the future economy. But we also want to be thinking about those other sectors as well. And so I think that, there's potentially some leverage in conversations with the government about these changes won't just be good for the venture capital industry, they'll be good for productivity. They'll be good for productive investments. One of the things a lot of people are talking about is that the government don't want you flipping houses, and the government don't want you essentially carrying through funds through different trusts in order to minimise tax. There's nothing illegal about that today, but these regulations go through, and they don't want people doing that. That has a very broad impact. So what you want to be able to say is just say, okay, well, if you're a butcher, a baker, a candlestick maker, this could literally be the thing. So if you can't invest in a startup and you can't do equity crowdfunding, or you can't become an LP in an ESVCLP or a managed investment trust, and you don't get those gains that you're expecting, how are you going to buy the house? Because if we're trying to improve the housing market, you need to be able to create capital in order to get the deposit and pay off the house. So I actually think that maybe part of the solution is broadening our perspective from just venture to saying that these broad-based changes that are proposed affect everyone. How do we make some sensible changes and some sensible carve-outs that, yes, benefit the innovation and disruption economy, venture capital, but also provide some relief, for others that would also contribute to productivity.
Yeah, and I think the unintended consequences are always interesting. So talking with an investor yesterday, he just came and he said, well, the safe note's dead, at seed at least. And I was like, oh yeah, why is that? And he said, I'm not going to risk not getting my ESIC, because if I don't get my ESIC, then my return profile now has to be double what it would ordinarily do. So I am not interested in a safe note. It's priced round, or in his word, pardon the French, fuck off. And so it's when you sort of think through that whole seed, pre-seed space where now there is a risk to getting that ESIC, there's a whole mechanism. And then another investor I was talking to last night, because I said, I think, doesn't it just mean that you'll have your personal ownership in a company and then that company owns the company you have? Isn't that all we're really talking about? He said, well, maybe, but if you're a really good founder, why would you stay in Australia anyway with this environment? Why wouldn't you go? And so my concern there was that investors making an assessment that I am not going to be able to find good founders, because they're going to bolt if we don't solve these other issues. And so he's telling me, I'm not even going to give you an opportunity to find those good founders, because I don't think the system is going to retain them. And so in that kind of uncertain environment, my life's experience is that wallets close and people just wait. And that's not really good.
Yeah. Well, it's worth saying maybe out loud that for people that don't know, is that internationally, the range for capital gains is around 20 to 30%. So 20, 25, that sort of number. And that's where we were sitting. So we were sort of sitting at 23.5% or 27.5%, depending on the structures that you had. So we were kind of competitive globally. But our neighbours, New Zealand, have zero. And Singapore is sitting at 20 something. So, if the capital gains rate is going to remain for an investment, whether it be a property or a startup or whatever it might be, or a small business, for example, if you're starting a small business and then you want to exit that small business, if you're going to be hit with a capital gains tax that's close to 50%, it's just not globally competitive. So I think it's a good argument that people have to say that why, as an Australian, would I choose to set up my structure here? I would probably want to set up a company in Singapore, or set up which is the same time zone, and they speak English and it's still dollars and all that sort of stuff, or New Zealand. So our two nearest neighbours offer a much more attractive capital gain environment than Australia does. I think that's a reasonable argument, but mostly for benchmarking, mostly to say we were competitive and we need to find a way to remain competitive. and make those appropriate changes. I think that's a good argument for that. But, the money will go, and the ideas, the people will go wherever the best environment is. And you can't forget that Australia has great beaches, a great lifestyle. A lot of people have backyards, good public park and good roads infrastructure. And so the lifestyle in Australia is actually good, and people are prepared for that 2 or 3% difference rather than setting up a company in the US or setting up a company in the UK or whatever. People are happy with a little bit of a difference as long as it's on global par. But if we're twice global, it's going to have a catastrophic effect.
Especially, I think, as well, for talent attraction, if you're also having to pay tax back in your home country as well. So that's just another layer. At the moment, if you're making capital gains and you're paying double tax because some of it's in Australia, some of it's overseas, you kind of end up roughly on par, but you wouldn't bother if you're then paying 3/4 of your capital gains winnings in tax.
Well, the other thing is that we're very resilient, and people are going to try and find ways to make whatever system gets implemented work for them. So whether we end up in ESVCLPs, whether we end up in managed investment trusts, whether we end up with safe notes, whether we end up, maybe everyone should just go to crowdsource funding. But people will work out the path of least resistance. And we're so resilient as a species, humans, that we will find a way to work around and within those regulations in order to comply, but also to keep Australia competitive. And I think that the easiest way to do that is to lobby government and get the carve-outs and the changes made to make it more appropriate, because it is so broad, these proposals. But then once they're in, it's, there's be a lot of consultants, a lot of lawyers, a lot of advisors, accountants and so on, working out the best ways to work within those existing structures. And we'll get there, but it's just been a bit of a shock, I think, for the industry. We sort of knew it was coming a few weeks back. And then once it was announced, everyone was like, it hasn't been thought through. It has a detrimental effect to most of the economy, and even the intended consequences are pretty harsh. The unintended consequences make venture capital and startup ecosystem very, very difficult, and we need to fix that.
My fear is that it has been thought through. That's what scares me more.
So I was just going to say, Batco did a great LinkedIn post where he basically made a mockery of set yourself up as an individual, create a trust, set up your own ESVCLP where you're the only LP, make an investment in your own startup, and then flow through the trust. And, they came up with this sort of farcical way but that's just because if it is thought through, it hasn't been consulted with industry, because industry would not have allowed that to be the first draft.
Yeah. This is just for my own, one of the things I just find it interesting. Why do multi-billion-dollar companies need the R&D threshold increase? That's the bit that I really don't.
Yeah, I think it's to support scale-ups like your Atlassians and your Canvas and those sort of things. I don't think it makes an enormous amount of sense. Maybe I'm a cynic, but the way I read that is that we've made a mess of everything over here. Let's distract everyone with the CGT and the ESVC and the R&D. Let's distract everyone with that while we're actually made a much bigger mess over here. Now, maybe that's too cynical, but I don't think a lot of those changes make sense. They're just making a change in order to say, here's some concessions for you guys.
Adrian DeMarco of Tech One is one of our LPs and a shareholder in the headco, and I was talking to him yesterday, and Tech One is one of Australia's poster children for that stuff, but even he says that why does Tech One, with all of its profits and its market cap and its access to capital, he sits there and says, why the hell should we get tens of millions of dollars of this? But maybe the Atlassian...
Well, the best answer, I think, is that people need to provide written responses and need to participate in the debate and provide that input. So what happened, for example, when the sophisticated investor proposed changes were, people like Cheryl Mack, rallied a lot of troops. We teamed up with a few different legal firms and our own legal firm. FinTech Australia consolidated feedback from 450 plus members. There were scores. I'm not sure the exact number right this second, but there might have even been over 100 submissions in order to educate government that those changes weren't appropriate. So I think we just need to do that. Now, the best ways to do that seem to be the Tech Council and FinTech Australia for us specifically in the FinTech sector. And that encompasses, obviously, venture as well. So I think that there are some forums to have direct channels. Now, the Treasurer's Office are responsible for this, and so any message that can be directly channeled through to the Treasurer, I think, is important.
Yeah, and I think at the ESVCLP level, the MIS level, like there's fairness, and then there's keeping the ecosystem delivering the outcomes that are often not monetary in terms of employment, sovereign capability.
Yeah.
And in a world where the chief cop has turned into chief firefighter, in a world where supply chains are so integrated and a little thing happens and it falls apart, that world is going to require us as a country to be far more integrated and have some more capacity. And anything that risks more offshoring of anything, I think, needs to be really well considered. So I would hope people listening to this have a really strong understanding of crowdsource funding, what you guys are doing in Birchal, some of the changes that you're going to be lobbying with. But until those changes come, we still have a world where you've got to sort of play with the current interface. So if people, both on the founder side who want to be looking at capital and supporting other founders, and then on the investor side, what's the process? Where do they go? How's best to attack it?
Yeah, for sure. So if anyone is interested in raising capital through crowdsource funding, jump across to the Birchal website. There's a quick form you can fill in. The team and I will get back to you. Otherwise, you can always email me. I'm Kirstin@Birchal.com. Actually, don't even worry because I have multiple versions of my name on the email. So send an email to Kirstin@Birchal.com.
You've solved that
if you don't
problem.
hear back from me. Exactly. I've solved the problem through brute force. And if you're an investor who's interested in hearing more about crowdsource funding or the particular opportunities, so for every deal that goes live on the platform, we have an investor Q&A. So you can sign up to our newsletter to hear about all of those. Or to be honest, drop me a note, same email as before, connect with me on LinkedIn. I'm always happy to have a bit of a chat about how this could help how crowdsource funding could help to build out your investment portfolio, or what role you could play in either companies that you're working with, helping them raise in the crowd, or companies who you might work with in the future.
I've got a practical thing that investors can do, is that we say no 99% of the time. And it's not because those companies are rubbish. A lot of the time, those companies are great, but they don't fit our thesis. They don't fit our return profile, whatever the case may be. What I would encourage is every venture capitalist, there's no legislation stopping us from doing referrals. Anyone that you say no to, refer it to Kirstin, because we want to get deal flow going to Birchal so that Birchal can not only continue to thrive, but can also elevate the whole equity crowdsource funding market. Best way to do that is if Airtree, Blackbird, Squarepeg, Artesian, Main Sequence, Tribe and Triple Bubble all send our deal flow that we can't invest in them all, send them off to Birchal, and they can look at equity crowdfunding as a potential way to raise capital.
I love ending in an action-orientated manner. I think that's a great idea. Well, guys, I really appreciate you spending the time. It's been a long time coming. I cannot believe we're in the middle of May, given, Kirstin, we spoke about doing this podcast last,
Well, I mean, we're at West Tech Fest in December.
Yes,
so
December.
That's already 6 months. But I think we've been trying before that as well. We were going to have a chat about gender investing even before that. Anyway,
just
worth the wait, hey?
Life just keeps getting in the way. But I look forward to getting this episode out. All the links are going to be in the show notes for anybody that wants to follow up. And Dom, Triple Bubble for investors, what's that all about?
That's a good point. So because I'm so involved in fintech, one of the things we noticed is because of the current regulations, it makes it very difficult for people for venture capital firms to invest in fintech. So we set up Australia's first dedicated fintech fund. It's becoming kind of an industry fund. Our first announcement was that our cornerstone investor was Commonwealth Bank through X15, which gave us a real good running start. We've got a bunch of other institutional investors now. Because we're specifically focused on fintech, we're raising a fund of about 50 million. Hopefully we oversubscribe. We're at about 15-ish now, but hopefully we oversubscribe and get closer to 100. But become really Australia's industry fund for fintechs. We have an enormous amount of deal flow. There's no way we can do it. Our first 3 deals, so they haven't been publicly announced yet, but our first 3 deals with the big venture capitalists doing co-leads and co-investments. So we are trying to be the glue in the industry for fintech. So anyone who wants to invest in fintech should call me. We'll set it up. And then anyone who is running a fintech and wants to raise capital should also get in touch. And we will do our darndest to help as many fintechs as possible to raise capital. And when we don't, we'll send them to Birchal.
Lead from the front.
Yeah, that's it.
Guys,
Thanks
really
for having us
appreciate
on.
your time. Look forward to getting this out.
Thanks, Dom.
Thank you.
Thanks, everyone.